LiteFinance, the
Hello, it's Monday, January 29th, and it is time to start the market forecast. So, on the calendar today, we don't have anything important. On the Tuesday, we will receive German and Eurozone GDP figures and US CB consumer confidence. On Wednesday, Australian and German CPI data, Canadian GDP, and most importantly, FOMC interest rate decision, where consensus says there should be no changes at this meeting. On Thursday, we will get the UK, US, Chinese, and Eurozone manufacturing PMIs, Eurozone CPI data, Bank of England will make their decision on interest rates, and OPEC cartel will have a meeting that day. On Friday, on top of that, we will get non-farm payrolls. So as you can see, the week is packed with key events and data publications, so much it can be very difficult to prepare and execute the plan. Right now we will discuss current fundamentals for the Euro USD. So, there are risks that PCE will rise to a new peak. Renewed supply chain problems and a strong labor market could accelerate inflation. The Federal Reserve does not want to lower rates and then start raising them again. In addition, improving financial conditions, including rising stock indices, falling treasury yields, and a weakening US dollar compared to the beginning of autumn, are doing part of the work for the central bank. The economy is being stimulated, which increases the risks of an increase in consumer price growth. Typically, the Fed resorts to monetary expansion when the economy is weak. However, the acceleration of GDP by 3.3% in the fourth quarter suggests otherwise. The regulator needs to be extremely careful to make the already hot economy red hot. In such a situation, much will depend on the labor market. A slowdown in employment growth in January and February or a significant slowdown in average wages will open the door for the Fed to start easing monetary policy in March. This will press down the US dollar, and therefore the US jobs report is a more important event of the week than the FOMC meeting. The decisions made at the meeting are quite simple. The Fed will most likely get rid of the wording that rates are more likely to rise than fall, which would open the door to monetary expansion. The Euro USD could start rising sooner if the Fed appears dovish to financial markets. However, the euro bears also have an important advantage: a potential correction in US stock indices. The 10 other S&P 500 sectors, excluding technology, are trading an average of 50% below their all-time highs. And if the 6 largest stocks fall back to their 200-day moving averages, the broad stock index would fall 5%, sending the euro even lower. Therefore, the Euro USD problems are clear. Bulls and bears are to find for levels of 1.085 and 1.08 until at least the FOMC meeting. I would wait and see, simply. And that will be all from my side. Thank you guys for watching, and till next time.